Good morning and welcome to the Team PLC investor presentation. Throughout the recorded meeting, investors will be in listen-only mode. Questions are encouraged. You can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Mark Clubb, Executive Chairman. Good morning.
Good morning. First of all, thank you very much for hosting. So thank you, Investor Meet. I'm just going to start with, first of all, thank you to the audience that I'm assuming are all individuals, not representing an institution. And I just want to deliver to you a message, which is that we as a company and I as an individual value our shareholders, all of them, whether you own 1 share or 10 million shares. And I believe that it's appropriate to, and we believe it's appropriate to allow individual investors to access our share registry. And that's the reason why we have a wrap offer out there. Retail investors are the bedrock of the foundation of the London Stock Exchange. And I really believe that this marginalized community on which the stock exchange was founded on remain a great force. And so I welcome addressing you all. This presentation is based on our September 23 numbers, which frankly seems and it is an awful long time ago. And a huge amount has happened. I think that let's start with who are we and what do we do? Okay, we are a broad wealth and asset management business. We're headquartered in Jersey, and there's good reasons for that. First of all, it's where I live, and I founded the company. But there are also good reasons: robust regulation, advanced infrastructure, lawyers, tax advisors, banks, etc., etc., etc. We do all the usual things that you would expect from a wealth and asset management business. We've got some complementary services, but I'm not going to zone in on those because they are a small part of the business. So the main thing is we look after people's money. We advise people on how their money should be looked after and what structures they should be in. We have a range of customers from individuals contributing to what you might call a SIP. In the outside world, that might be a QUP, regular savings plan, structured, not structured, life rapid, not life rapid. And then we actually manage money as well, and that's the asset management business. We listed our name in 2021. You can see on this slide who the main shareholders. The takeaway from this that I would have is that John and I, John is head of Team International. We own over 20% of the company. So we have real skin in the game. That's quite unusual. I have no options, no MIP, neither has John. We bought our shares, just like you or any other shareholder. The top right-hand slide is what you'd expect to see from a company presentation. Guess what? We've grown. And I would argue that we've grown very satisfactorily. And the key now is to convert that growth, which will continue, into EBITDA, what I refer to as escape velocity. And we are very, very close to that. And you'll see through the rest of this presentation as to why I have such confidence in making that statement. So here's a little bit about how it all began and the journey to where we are today. Theta was the bedrock foundation acquisition, very small asset management business, typically defined as a private client business, direct clients, sleepy lifestyle business, but it had all the approvals, which made it a good acquisition for me and my fellow shareholders in a private company to enter the arena. We acquired a business called JCAP, which is treasury management. Back then, people had forgotten about cash because it didn't earn any return. But cash is an asset, and it should be in every suite of assets available to invest in. Omega was our first foray into the advice market. And the reason why we did that was because we identified that advisors had myriads of different strategies for the investment of their client monies. And we wanted to bring them into a disciplined manner for investing. Omega was the first very profitable little business, two-man business, didn't pay a lot of money for it, integrated now quite well. There were some regulatory issues. We were aware of that before we bought it. Then we bought Concentric, another advisory business, but interestingly, also with a consulting business, giving advice to high net worth individuals, family offices, quasi institutions in terms of risk reporting, investment manager selection advice, all data driven. Those were all Jersey centric. Matthew, my finance director, likes to use St Albans as an analogy for Jersey. It's about a population of 100,000, relatively affluent, but we needed to go further afield. And our clients were actually taking us further afield. So the Global Eye acquisition gave us the licenses that we needed in Singapore, Middle East, South Africa. And then finally with John and Niba, that gave us firstly John and his management experience and expertise, his network, and a fund distribution business. HBF on the slide is a proposed acquisition, Jersey based. Whether that happens or not will be reliant upon the fundraise. Sorry, just to dip back a couple of slides. Matthew is CFO and COO, joined me pre-IPO. Matthew, do you want to just say a couple of words about yourself?
Yeah, hi, yes. So I'm Matthew Moore, I'm the CFO. I'm a qualified chartered accountant. I had a career in the city working at Barings and Cazenove before working for Close Brothers in their wealth division. And I've been the CFO and the COO of 3 IFA businesses, one owned by Aegon, one Close Brothers, and one owned by a USP company that was recently sold for £600 million. So I'm very experienced in the world of fund distribution and in wealth management.
John, I sort of half sung your praises, so 2 minutes on John.
So John, I was the founder of Niba Financial Solutions, which, as Mark mentioned, was a fund distribution business to the offshore expatriate financial advice community. I also founded Niba Wealth Management, a financial advisory company with offices in many locations around the world. That's basically it in a nutshell.
Okay, thank you. So let's get to the meat and drink of it. We have indicators pointing upwards, AUM, AUA, staff, all those usual things. But the key takeaway is that strategic progress. Go back to what I just said. Prior to June last year, we were Jersey centric. Now the world is our oyster. But importantly, we have moats. We have deep moats, and they're called regulators. So we have regulatory approval in the places where we want to be, and there are a couple of other places where we would like to have regulatory approvals and add to our collection of moats. And I'll explain a little bit later on, or John probably will, in terms of why these moats are so valuable and are the bedrock for revenue growth, recruitment of advisors, and consequently money going into our asset management business. I can pick and choose from this, again, numbers-based highlights. Again, this is very much historical. But you know, we have grown the AUA and the AUM very successfully, and I think that trend will continue. And again, I can say that with some confidence because of, I think it's the next slide that we're going to go to, which is the performance of our bedrock models, which are cautious balanced growth, 100% equity and diversified income, are very, very market competitive, and they are priced market competitively. There's a question later on that I'll answer, which deals with the investment management side of things in a bit more clarity. So if I may, I'm going to answer that at the end. But if you're going to sell something, it needs to be a good product. We have a good product, and it's highly scalable because it's systematic. The reason why we can have some confidence in the growth in AUA is because of this slide. And I'm going to hand over to John to run through this one. John.
Thank you. So Team International was formed out of all the acquisitions outside of Jersey. So NIBA is included in that. And most of the rebranding in there will, from all the different offices, will come under one brand, which will be the NIBA brand for wealth management. The wealth management company has a huge expatriate focus. Why do we focus on the expat market? Well, there are millions of British expatriates living overseas. In fact, the vast majority of our clients are British people who live overseas, and the advisors are British financial advisors who also live overseas. Myself, I'm speaking to you from Singapore, where I've lived for the last 15 years. So expats, generally, when they live overseas, they get a bump in pay. So you'll have someone who maybe earns £200,000 instead of paying huge amounts in taxes and housing costs, a lot of those things are either paid for by the companies who send them overseas, or they live in much lower tax jurisdictions. I think I paid £900 last year in taxes in total in Singapore. So it's a very cost-effective place for me to be tax-wise. So without all these expenses, it gives a much higher disposable income for these people who live outside of their home countries. We don't just deal with British expatriates. There are some other nationalities as well. These expats would probably have a much larger savings plans. So instead of saving maybe £200-300 a month, they can save £2,000-3,000 a month or more. We've even had some that are as high as $20,000 a month into a savings plan. So there's a lot of disposable income with these expatriate communities. So we basically are using the growth of the wealth management division to take the money that we've got, 319 million, as you can see from this slide at the moment. At the moment, none of that is invested in team asset management's models. So the idea is to take that and move that into the team asset management models, which will create revenue from the management fee, which will only benefit the shareholders. The regulatory offices that we have in Singapore, the UAE, South Africa, and Malaysia, these are the building blocks which Mark has spoken about before. That allows us to give a proposition to the expatriate financial advisors, which no other company can match. Not only are we listed, but when expats who are mobile, including financial advisors, some of which who work for us have lived in 5 or more different locations, when they move or their clients move, having multi-jurisdictional licenses allow us to carry on the flow of advice from one location to another. That means we don't really lose AUA when clients or the advisors move locations, and we can continue to look after that client's money in our models for a much longer time than any of the competitors in the offshore market space. The whole proposition for Team International is aimed at financial advisors. not necessarily the clients. If we do a good job for the financial advisors, they will do a good job for the clients, and we'll give them all the tools to do so. There's not too much difference between financial advisory companies, apart from those building blocks which we have, which will help the financial advisors give a much better global service to all their clients. And it will also help us to bring their clients into the fold. One of the top things that financial advisors like about our proposal is the guaranteed buyouts that we can give them after 5 years of service. This will enable most financial advisors in the offshore world find it hard to find an exit for their business. They can't sell their book of business. It's invested in too many things. So over the 5-year period, we will take their money and put it into Teams models, making it of value to us. We will help other financial advisors purchase that book, and we will keep the assets with us. And it gives the financial advisors an exit strategy. This has given a lot of financial advisors a great incentive to join us. So over the last few months, since NIBA has been purchased, we were purchased in December, we've already increased the assets AUA by 47 million. We have 550 million, in our pipeline to join, of which 180 million's worth of AUA. Those financial advisors have signed contracts with us and given us a list of all their clients' data who are coming over, and we will be able to increase that AUA figure more and more, and again funnel that money into Team Asset Management's model portfolios, which again, with the management fee, will benefit our shareholders.
Okay, thank you, John. So talking about benefits, because this is the sizzle, if you like, that will come through, and is very well articulated in a research note recently published by Ben at Hannam, with a target share price of 70p. Matthew, do you want to just quickly run through the P&L and then how this flow of assets will impact our earnings? You're on mute.
There we go. Thank you, Mark. We run a fairly simple set of accounts. So we receive income from investing clients' money. So that's the investment management business. We receive fees from clients for giving them ongoing financial planning advice and for treasury services. And we also have various ad hoc other fees that come through our consultancy work. That's the revenue line. In the last year, it went up from 2.2 to 5.3 million. So we are up 152% year to year. We're up 300% since our IPO in March. And whilst we can't give guidance for the future, if you look at the research note that was published, as Mark refers to, the revenue forecast for next year is 8.5 and the year after that is 10.5. So you can see there's a rapid rate of growth in the early years of our development. Now, the cost base of the business is people and offices and licenses. We share the revenues that we earn with the advisors. So there's typically a fixed revenue share. It's different in different parts of the world. In Asia, it's around 70%. In Jersey, it's more like 40 to 50%. We then have salaried staff who are the investment managers, who are the support staff and the management. And then we have the physical offices. Most of those costs are now fixed. We do not expect to need further physical offices, further management, and further salaried staff. So we expect the incremental revenues to be coming through without much additional cost attached to them. Our profit for the last year was, on an underlying basis, we lost £700,000, which is not good to lose money. We recognise that. But as part of the early year development of the business, we think that was an okay result. It's better than the year before, where we lost £800,000. And we expect to be producing a cash break-even position, not next year, but the year after that. It'll take a while to get the client's assets from where they currently are managed into our investment management business. But once they are there, we expect them to be very sticky. So the client retention we expect to be in the high 90s. We expect them to be growing because they're invested in sensible, long-term, secure portfolios. And we expect clients to continue to add to those portfolios through their regular savings and pension contributions. So everything is pointing towards a fairly static cost base, but an increasing revenue line.
It might be worth pointing out, Matthew, just in terms of the loss, the 700, there's a certain amount of synchronicity in numbers. Our PL, we do have the one other cost that we have is the cost of being a listed company.
Yeah, so if we now report the business in 3 divisions. So you've got investment management, which is running the money. We've got advice, which is the Jersey businesses. And we have international, which is John's business. As Mark pointed out, we then have head office. Head office is Mark and myself, plus the non-executives, plus the other things required to be a listed entity. And as you can see there, that costs in the region of £700,000 a year to maintain. So again, it's a fixed cost. It shouldn't go up, but it is a real drag on our profitability in these early years.
Thank you, Matthew. Anything you want to pull out? No. So, okay. So here am I, potential investor and team. What am I buying? Well, you're buying a rather unique exposure in terms of the London listed market to markets that John has talked about that display growth to high growth, and the opportunities are vast and rich. All the reasons that John described. I think John says that there's over 40,000 financial advisors in the international market. Many of them are 2-man bands. I mean, I'm in communication with a 2-man partnership in Cayman with all the approvals. I've got a 2-man band in Rome. This is how they tended to congregate. But you know, demographics are such that these guys and regulation to a degree is starting to catch up with them, that we are a perfect home for these people. So it gives you exposure to individual savings markets where the individuals have a much, much higher disposable income to put aside for their retirement or other financial needs. You know, average monthly contribution per average client in John's world is around about $4,000 a month. You've got to go a long way to find that sort of dynamic in the UK. The next thing we're getting as a potential shareholder, investor, is the platform's already been built. Your money is not going to go towards building the platform. That's built. Much of the growth going forward will not be acquisition in the sense of corporate acquisition, but will be the recruitment of individuals. Most of them will be self-employed, so we don't even carry the cost of them working for us. That means that our profit margin will improve. As that scale grows, our profit margin will grow. Escape velocity. We are moving towards the path of cash flow break even, which means that this last funding round will be the last in terms of getting to that cash break even. And you know what? We look forward to paying dividends. There are just so many opportunities in terms of hiring individuals and teams. You know, John is in conversation with teams. I'm in conversation with teams. You know, we've got somebody who has approached us, who I am very confident will join in, say, August, September this year. He has a £350 million book. So our midterm ambition is to hit 20 million of revenues, 30% EBITDA, 4 billion. So just think of it this way. We are aspiring to have more than 100 advisors by the end of this calendar year. 200 next year, 300 the year after. One advisor, average book of $15 million. Do the maths. We will get there. So I think that now is a good time to close the sort of formal presentation and start to address some of the questions that have already come in. Thank you for the questioners. All good questions, actually. So I think I'll start with, first question is, can you give a summary of the performance of your various model portfolios and a commentary on how performance has been influencing relationships with existing and new clients, including net flows? Yeah. So maybe a little bit about the way we manage money to start with. So the genesis of all of this really was that we decided that the investment landscape of the last 25 to 30 years was highly unlikely to repeat itself over the next 25 years. And what does that mean? Ultra low interest rates, disinflation, basically a buy whatever you like, it'll go up. All the quantitative easing, etc., etc. That has all now stopped and unlikely to return. To prepare for that, we expanded our asset allocation menu. So we are asset allocators. We have a multi-asset strategy covering 25 different asset classes, 5 being core: fixed income, absolute return, equities, alternatives, cash, real assets, including infrastructure. And that's spread across 50 global financial markets. What we think is that the pandemic was a real shakeout. It was a real shakeout of the foundations of what had been the conventional 60-40 portfolio construction. Far too many other managers were carrying way too much exposure to, for example, conventional bonds, which are now much, much higher volatility. So we moved things. So, for example, we had no bond exposure from March 2021 to March 2022. We invest with conviction, and that means that we minimize transactions because transactions are costs, internal costs, and that improves the overall performance outcome. Basically, we try not to be busy fools. It's about stay in the game, no surprises. And I can't give you the to end March numbers because they haven't been published yet. But as you can see from this slide, we are generating, at the very worst, benchmark aligned returns over whatever period you want to look at, to actually quite significantly better returns. The longer term returns are better because we it's lots and lots of small incremental gains that over time build up. Now, this is perfectly set up for John's clients who are making $4,000 regular contributions. Absolutely perfectly set up. So performance is important. The way we manage money is important. It's important in terms of our relationship with our clients, and in terms of inflows and relationships. What I can tell you is close to 100% of Omega's clients moved into our model range, 80 odd million, over a period of 10 months. But it's not just our own advisors who are now starting to use our models. We have a great relationship with a number of third-party advisors, so nothing to do with us. They just like the way we manage money. One of which is Sovereign Group, possibly the largest QROP trust and admin company in Europe, but also many trust companies, JTC, Equiem, Oak, etc., where they have discrete trusts whose assets need to be managed. A very, very important point about the models is that the models are all non-UK situs assets. And that's important from a tax planning perspective. Why do I think we'll see continued good flows? Well, first of all, we're establishing a business in Guernsey that will result in good flows. We've got John and his team. As soon as we unitize these models, which will come very shortly, We have three options for that. John's distribution and John's advisors can start to access these models. So it's a bit a case of, show me the incentive and I'll show you the outcome. If we go back to the very first slide, the name of the game really is to take that green and put it in that blue. That blue is at an investment management fee of between 50, 0.5% and 1%. That green will grow for all the reasons that John has given you. It's already grown, frankly. It's already up 47 million. And the marginal impact to our bottom line of it going into the blue, Matthew's explained to you. And the conversion of that revenue is going to be somewhere around about 80 to 90%. We don't pay any tax at the moment in Jersey, and we have tax losses. Once those are eaten up, the maximum tax we will be paying is 10%. So I'm confident we'll get inflows. I'm confident in the models because the models are systematic. We manage volatility, we manage risk. We don't necessarily manage investment outcome. They're going to be unitized and they're going to have a very, very competitive OCH or TER, however you want to use it. And underlying those unitized versions will be a named trust and admin company. The decision hasn't been completely made yet, but it'll be somebody recognizable. You don't get fired for buying IBM. The next question is a really, really great question. Given the depressed share price, what is the rationale for deciding to plow on with more acquisitions in the last several months instead of, for example, waiting to see the financial synergies of the first few transactions and then raising funds at a better price once the clean post-integration stats are clear to see? Does this imply that some of the early transactions were have not quite led to the synergies and financial results hoped for? Okay, right. I could have asked this question myself, and actually quite often do. This is a question of three parts. It's really three questions. So let's deal with the first one, which frankly is the elephant in the room. It's the elephant in the room of all conversations with our existing shareholders. Look, the London Stock Exchange is not an efficient pricing mechanism. It really isn't. And there's been much gnashing of teeth on this. I mean, only this morning into the Today programme, even Royal Dutch Shell are looking to move away from London and list in New York. I can't fix the London Stock Exchange problems, right? It is well known that it is not an efficient pricing mechanism. And we know that because of a lot of the off-market transactions that have been going through at significant premiums to the pricing on the market. And it's not just our sector, it can be a paper manufacturer, DS Smith. I think the London Stock Exchange has got real issues. But it does benefit us because when John is in foreign climes, shall we say, being listed on the London Stock Exchange carries quite a substantial intangible value. And for now, given the fact we're so close to that escape velocity, I do believe that we should maintain our listing before somebody asks that question. We're not alone in this. I was looking at some other prices. Premier Mighton's down 71% since January 21. The Enfant Terrible of St. James's Place are down 73%. AIM is down 38%. We're down about 69% in that time period. But that's the opportunity. That is the opportunity. The disconnect between an off-market value of our business versus how the current market is pricing us. Below book value, below revenues, forecast pro rata revenues. There's a research note out there that suggests 70p as a target price. Are Premier Mighton's shares or St James's Place or any of our other peers, are their shares going to double in the next 2 years? Question. Moving on, that's just very lastly, obviously I continue to buy shares and not in a meaningless amount. You know, a couple of weeks ago, week ago, whatever, I bought another 170,000 shares. So I do follow my money. John has as well, and many of our other staff and senior management have. Let's just go back to the second part of the question, which is about the last few transactions. Just to be clear, the last transaction was NIBA, that was all shares. And at the time, the shares were 36p, not 20p. Before that, Global Eye was in June when the share price was 41p. But let's go back to the point I made on slide here, slide 6, strategic progress. Without those acquisitions, we would still be a Jersey-based and constrained business. We wouldn't have the moats. We wouldn't have the building blocks. I mean, John, probably a good time. Why did you do the deal with me, John? Why did you do the deal with us?
NIBA was expanding in the offshore market space with the proposition we have, not only with the distribution company of Singapore, where we have terms of business with 180 different financial advisory firms to the expatriate community, but doing a deal with Team allowed us to access their models to promote them to those 180 expatriate advisor firms, but also NIBA only had one wealth management license, which did cover many of the locations we were in. But having more global coverage, South Africa, UAE, Middle East is a huge one for us. A lot of our distribution is in the Middle East. And the other licenses like Singapore, so hard to come by, it just attracts the top wealth managers in the offshore industry. So it kind of put a rocket up the backside of the, I don't know if I should say that, but that's exactly what it did, is put a rocket up our recruitment efforts. And instead of just getting millions per month, like I said, we've got 47 million and now 550 million in our pipeline at the moment, with 180 million already signed to move across to us. So the proposition being part of a listed company is just unmatched and unrivaled in the offshore world.
Thank you, John. You know, in terms of the third part of the question, the synergies and the historic acquisitions, look, there is some validity in that statement. I think there's validity in that statement in any acquisition, in any acquisitive company. You know, running a business, let alone integrating a business, is like daily life. Good things happen, bad things happen. It's not a linear progression. And, you know, the key is adapting to those changes, you know, and that's what we did. You know, we got hit with that inflation bout, you know, where, you know, our wages went up more than we probably would have forecast when we made the acquisitions. You know, there has been, I'm sure you'll all be only too familiar with the cost inflation that we saw, particularly last year, and really actually coming in, you know, midway through 2021. I don't mind leveling with you. You know, things always take slower. You know, the business plans are great. The thing that goes wrong with business plans is the timing. But you just have to work your way through it, which is what we're doing. And, you know, I think the last 10 months in particular have seen that we have worked our way through that. And the single reference or benchmark that I would use is the integration of Omega and the transfer of 80 to 90 million of assets into Team Asset Management. If you go back to this time last year, we didn't have any of those assets. Now, in the business plan, we did, but by end of April last year, we started to see that flow. But what I can tell you is that I can't give you the exact timing. Unfortunately, I don't have a crystal ball. But what I can tell you is that we'll continue to grow where we can. And you know, John in particular has got some fantastic growth opportunities. And you know, ultimately, we want to be in a great deal many more places. You know, we want to be in Europe. We want to be in the Caribbean, and we will. I'm sure that you all in this audience know somebody or may even experienced yourself leaving the UK to go and live and work or retire abroad. When you do that, you have needs. You have financial needs. All we do is address those needs. It's very simple. Moving on to the next question, so you don't get bored of my voice. Matthew, why don't you answer the next one about strategic ventures? You're on mute.
It's me. Back on.
Yeah.
We bought GlobalEye, and there were two shareholders. One was the founder. Another one was a European family office who held 51% of the shares. So they swapped their shares in GlobalEye for shares in Team PLC. So Strategic Ventures is a European family office, and we have a cordial relationship with the principal behind it, and they're not important to our development. They are a shareholder, and they support what we're doing at the moment.
Thank you. I'm actually seeing them tomorrow afternoon. So the next question is, what are the key benefits of the systematic active investment process, and can you talk about the UCITS range? Well, I think that the benefits are sort of two sides of a coin, really. There's the client benefit, which frankly is you haven't got a bunch of humans making human errors. We manage via a system that is backed by BlackRock technology and their 100 years worth of data. Without going into the nitty gritty of it, what we are looking at is correlation, volatility, the depth of trend and momentum of that volatility. And what we are managing is the overall risk of that portfolio. So if you were to take a balanced portfolio, it has, if you like, a risk budget of 12 to 14%. And it never strays outside that because it's a system, so it's hardwired with all circuit breakers, etc., etc. The active, it doesn't tell us to buy A and sell B. It just tells us the relationship between A and B has changed. And that relationship change has a depth of trend and momentum. The decision, the active bit, is the decision as to whether to sell A and buy B, or vice versa, or whether to keep A and increase B, or vice versa, or increase both. We only move in increments of 2%. Unlike many other people who tinker around and they, increase their exposure to Japanese equities by 25 basis points. They churn the portfolio over, racking up charges internally, which is all you're doing there is dragging on your overall investment performance. So we take a keen. So being systematic, only moving in 2% increments means it's conviction, but it also means, because it's conviction, before you make a move, you give it some thought, which minimizes trading. Interestingly, we've just done some back testing going on to the UCITS point. And And interestingly, assuming that the UCITS is above around about 35 million in NAV, unitizing the models actually adds around 10% performance. And it brings the overall charge, so this is everything, down really quite considerably. So from a client point of view, it's very beneficial, cost effective, does what it says it does, because it can't do anything else, basically. On the company side, because it's systematic, we don't have skyscrapers full of analysts working out whether to buy Procter & Gamble and sell Unilever. Broadly, 80% of investment returns are driven by asset allocation, not specific investment. Hopefully that answers that one. Anything to add, guys? David, why don't Matthew, why don't you answer the next one?
So can you explain who is HBFS? HBFS is an IFA business in Jersey. We exchanged contracts to buy the business last year. That exchange was conditional upon a number of things, one of which was JFSC approval. Another one was raising sufficient money to pay for it. At the moment, it's unclear if we have raised enough money to do that. The fundraise is still ongoing, so that is a live position. In terms of what it brings to the group, it's more the same. So it would have brought another 2 or 3 advisors to our team in Jersey, and hopefully it would have given us some benefits of scale and consolidation. Well,
okay, I think that is questions that I can see. I don't know if there are any more coming in.
No, you've covered off all those questions, Mark. Thank you very much indeed. And of course, any further questions that do come in, you'll be able to review those, and we'll be able to publish responses on the Investor Meet Company platform where appropriate to do so. Mark, perhaps before redirecting investors to provide you their feedback, and those particularly important to you and the team, could I just ask you for a few closing comments, if I may?
Yeah, of course. Look, thank you, everybody. Thank you for your time. It's a competitive landscape wherever you go. And, in terms of investors, you've got a vast array of things you can invest in. So, we're competing against, God knows how many thousand other people for your investment. So I appreciate the time. I think, everything has risk, but one of the lower risk things you can invest in is sticky, regular savings money. It's annuity income. So we have a very, very long runway. And we're small, which means that we can double, treble, quadruple our revenues, our AUA over the coming 2, 3, 4 years, without really bumping into a lot of competition. We are unique. Recently, we were told by a very large international platform that what we were doing was unique, that the range of our moats was near to unique, but the way we were going about the business was years ahead of everybody else. John has got a fabulous team, fabulous. We've got fantastic regional managers now that all have deep, deep experience. They're motivated and they're disciplined. The offshore market in international centers is decades behind the UK in terms of regulation and good practice. It's ripe for cleaning up, not just in terms of recruitment, but also cleaning up practice, industry practice. If we are at the forefront of that, the pioneers of it, we will have very sticky clients and very sticky revenues for long after I've gone. And that is a unique opportunity versus our peers. We can double, treble, quadruple. I'm not quite sure that our other listed peers can do that with any sort of confidence or certainty. The UK has become just a merry-go-round of consolidation. There's no real organic growth, or limited. We've got organic growth in bucket loads. The year has started well, and I'm very confident it will continue to go well. And that is the opportunity above, and it is head and shoulders above our peers in the listed sector. Thank you for listening.
Fantastic. Mark, Matthew, John, thank you very much indeed for updating investors today. Can I please ask investors not to close this session, as you'll be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. This only take a few minutes to complete and know greatly valued by the company. On behalf of the management team of Team PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you very much.